I think that, investors are starting to think whether or not there really will be a soft landing, and therefore hedge funds are trying to take advantage of those dispersions in sort of market views at the moment. And there's a lot of debate at the moment whether people should be, long only equity investors, or if there's a smarter way to approach equities. And I think you see that in the positioning at the moment.
I just mentioned the trading around the banks as well. It's been a very fast-moving market of late. Concerns that went from a banking sector that was the darling of the markets to concerns around the sort of leverage, the lending practices of some of the banks as we wrapped up the month of March and the first quarter. Just how quickly did hedge funds scramble to reposition around those banks?
I think it was quite quick. I think what you saw in particular, though, is that those managers that were positioned for higher rates as telegraphed by the Fed, those were the ones that suffered and had to reverse their positions quite quickly. And so I think you saw the performance in global macro funds and CTAs in March with some of those suffering. Having said that, this sort of dispersion should create more opportunities going forward. And as you said, you've seen a number of managers having done quite well from the Credit Suisse situation, for example.
Patrick, 2022 was clearly difficult. I think Reuters wrote it up as the worst year for hedge funds since 2018. What have managers learnt from their experience of 22 that is still valuable in 23?
I would actually challenge that narrative, to be honest. I think 22 was a pretty good year for hedge funds as long as you were selective in terms of the strategies that you employed. So if you didn't invest in sort of long biased equity managers and you buy the beta, you did quite well. If you look at the performance of trend followers and macro managers, they've had some of the best years in a very long time. I think what it really comes down to is strategy and fund selection. And 2022, I believe, showed that. The other problem in 22, of course, was that fundamentals just didn't work. So if you had managers in strategies like equity market neutral, they didn't get rewarded for their work. We looked at managers that got 98% of their earnings calls right and still lost money. So in that type of environment, you need to pivot and you need to be very careful about the type of strategies that you employ. I think that's the main lesson from a year like 22.
I mean, you can challenge the narrative, but you can't challenge the data because that's pretty clear. And it was the equity strategies that seemed to let a lot of people down. I partly agree with you. This could be encouraging because hopefully it will force out of the industry the closet trackers. What does the experience of previous periods of rising interest rates tell us about the performance of managers over those periods?
I think you made a very good point. The first point being that equity strategies and hedge funds, even though they're the largest part of the industry, I think it's not entirely fair to just look at that. And as you've said, a lot of those are closet trackers and haven't done well. And we have historically underweighted long-short equity managers for that reason. I think the other question that's really at the forefront right now is you have an alternative. With rates being where they are, cash is an alternative right now. And I think that's the biggest challenge to the industry. How can you stay relevant? But it's not just a question for the hedge fund industry. It's a question for asset management in general. Why should I take risk? And so when we look at periods of higher rates in the past, what we see is that many managers actually generate higher returns. A lot of them have high levels of unencumbered cash, 80, 90% in the case of CTAs and macro managers. And that provides a tailwind. But it also means that with higher rates, risk needs to get paid for. And so typically what you do see is much higher returns for hedge funds in those periods.